Hi everyone. Good morning. We'll we'll start this webinar in about a minute or so. Let's wait for some more people to join and then we can get started. Great. Good morning, all of you. Thanks a lot for joining this. Um, I will basically start with a small intro to wealth culture because a lot of people are joining us on YouTube for the first time. So basically, we are a SEBI registered RIA firm. I myself uh, I'm the founder. We started this company in about 2022, and as we stand today, we are close to about anywhere between 60 to 70 crores of assets under advisory right now, which includes equities as well as mutual funds. And very recently, we've started advising on mutual funds also. Uh, Firstly, because we realized that a lot of capital goes there, and a very under-advised segment, especially with a lot of mutual fund distributors occupying that space and charging hefty commissions. Right, we believe that we can do a much better job. First of all, of identifying good mutual funds that can outperform the index. And while we do that, we charge a very reasonable, much more reduced fees than what the mutual fund distributors charge, right? So that was the idea. However, equities remains our core, and over the last, as I'll take you through our small case performance, we've demonstrated our ability to outperform the markets since we started this business. So both of our small cases are about 3.5 years old now. Between in these 3.5 years, we've seen bull run also, the post-COVID bull run, as well as the correction that we saw last year, starting September, October, and it continues sort of into October this year. Also, we've seen a lot of FII selling. We've seen a lot of the Indian economy itself go through a cyclical downturn, right? And Indian markets have been the most underperforming markets globally, right? So in that context, uh, we are looking at a 37-38% CAGR, and our VC investors portfolio is among the top small cases on small case, right? So with that, but like I said, we've also started mutual fund reviews. So if you want to get your mutual funds reviewed, then let us know. We'll do it for free. And the ongoing advisory also comes at a very reasonable fees, very reasonable fees, I must say. We charge pennies for doing that. It's just because we see a lot of capital deployed there. Otherwise, that is not something where we have a lot of advisory role to play, right? We can definitely play some sectoral mutual funds depending upon what sector is doing well at what point of time. But beyond that, there is very little role to play on that side. Equities remains our core, and which is where we continue to outperform. Uh, so moving on, I think this session is going to be really, um in my view, I think I have tried to add a lot of perspective into these session from especially outside markets, right? Outside Indian markets. So we'll evaluate US more closely, we'll evaluate China more closely, we'll evaluate what's happening there, what these countries and nations are doing, because Ultimately, look, 2000 dot com bubble was not something that was Indian manufactured, right? It was manufactured in US, affected Indian companies. 2008 financial crisis again was not something that happened in the Indian economy. It happened somewhere outside of India, and eventually it affected us significantly, right? So a lot of these uh, crises originate outside of our country. At our end, the max worst that happens is we go through a cyclical downturn, which is general economics, right? So it happens in the course of the growth that we are seeing. You will see some years when we will do very well, and you will see some years when we will not so do well. And so that effect, anyways, reflects in our markets. But a huge factor comes from outside of our country. And although the domestic participation in India has increased significantly, but we do get a lot of, like I was saying, a lot of FI selling has led to correction, and India performing as one of the most underperforming markets globally. So that definitely affects our market. And from that point of view, I think we are at a very crucial juncture. Now, I've been talking about this for some time now. In fact, this was the reason why we started buying gold and silver last year and also bought Hang Seng Bees, right? Again, none of this is advice. Uh, so please do not buy or sell depending upon this, what I'm saying in this, webinar today. This is only for educational purposes. So last year, somewhere around this time only, I think no much before June, July, we started talking about inflation going up in US, and and that's when we started hedging. Basically, we started moving to silver, gold, and we started focusing on capital protection as against capital growth. Now, as we stand today, to me, it seems like we are much closer to a recession in US than before, right? So I will talk about two, three big reasons why we think that we are closer to a recession in US. One of the reasons that you see on the screen, this is something called as yield curve inversion, right? So yield curve inversion is nothing. What you're seeing here is two lines, blue and red. This blue line is the 10-year treasury yield minus the 3-month treasury yield, and the red line is 10-year minus 2-year. So what happens is typically, when you are looking at a treasury yield chart, you will see that the 3-month treasury has lower interest rate versus the 10-year treasury, and the 2-year will have a slightly more higher interest rate than the 3-year treasury. So longer the tenure of the treasury bond, higher is the interest rate. And this is because in the long term you have higher risks, right? So risk versus reward goes along. So higher risk, higher reward. And that is why the 10-year treasury bonds have higher interest rate versus the 3-year treasury bond. Now, if the 10-year minus the 3-year is a negative number, which means it is going into zero, that means that the 3-year treasury bill has a higher interest rate than 10-year, which is not the usual case, right? So there has to be a certain reason why that might happen. That your 3-month, the interest rate that we are running on the 3-month treasury bill is basically higher than the interest that we are running on the 10-year treasury bill, which means there is more risk than in the 3-month or the 2-year treasury bill as against the 10-year treasury bill, which is not the usual case of things, right? So this typically leads, and the way the markets conclude this is that there is much more risk in the shorter time frame. So we are looking at a 3-month to 2-year or a 3-year time frame where we believe that there is much higher risk in this time frame as against the 10-year time frame, and hence the bonds have a much higher interest rate because there is higher risk associated with 2-year and 3-month or a 1-year or a 2-year treasury bond. And this higher risk is concluded as if that the economy is about to go into a recession. There has been only a couple of times when this has happened, as you can see, and these lines that you see, these are phases of recession, right? So we saw this during 1980s, 80, 82. That was the time frame when, the red line went below the zero, And eventually, just after that, as we saw this red line go up, we saw a phase of recession. Similarly, so what happens is that this phase of negative 10-year minus 3-year treasury bill or 10-year minus 2-year treasury bill is immediately followed. Now, when I say immediately, this can be anywhere from 6 months to 1 year, 2 year as well, right? There's no fixed time frame. Uh, but one thing is sure that once the recovery happens, once the 10-year minus 3 month starts to go in the positive trajectory, that's when you see the recession happening in US. In all of these cases, you will see that we go into a negative zone and then sometime after that we go into a recessionary phase. Again, here also we went into a negative phase and then post that there was recession, negative phase, recession, negative phase, recession. Now we've spent quite a bit of time in the negative phase, right? So this is one of those times when the yield curve inversion has been for more than 500 days, right? And you can see the length of this inversion. It's been more than 500, 600 days. Every time this has happened in the past, in the recent known past, this has always been followed by a recession, right? So there is no, I think we are not, we certainly believe for a fact that we are closer to a recession. Now, we can't say whether it will happen in 3 months, 6 months, a year, uh, right? But one thing is for sure that when this starts recovering, when this starts going above the zero, that's when the chances of going into a recession increases. Now, I've been talking about this since a year, but I think we are much closer to that. Uh, to a potential recession in US over the next 3 to 6 months, if not 6 months, then at least a year. Within the next year, I think we should be able to land in that zone where the US overall economy goes into a recession, right? So I hope this point is clear to you. Now, why we believe that no, it's not just one factor that will lead to a recession. There will be multitude of factors which will come together. There's one more bubble that's I would like to call it a bubble, and I'll explain why. There's this huge AI bubble happening in the US right now, where a handful of companies are driving the entire S&P, right, to its all-time highs. And the reason, and there's a lot of looping here, so to say, and I'll explain. So first of all, to tell you that these magnificent seven stocks, which are your well-known AI stocks like Nvidia, Microsoft, Alphabet, Amazon, Apple, Tesla, whatever. Today, just these 7, 8 companies contribute almost 36% of the S&P 500. In fact, Nvidia alone is about a $4 trillion in market capitalization, right? Which is just huge, huge. And the S&P overall price to earnings ratio is anywhere between 28 to 30 times. It sort of goes up and down in that zone, whereas the long-term average is about 2021, right? So we are significantly higher than the long-term average in terms of the price to earnings ratio. And especially on the AI side, why I believe that there is some sort of looping here, which means it's like a stack of cards wherein a handful of companies they do a lot of business between each other. So just to give you an example, Nvidia has invested significant amount of money in OpenAI, and OpenAI uses that capital to buy chips from Nvidia, right? So there is money coming from Nvidia to OpenAI, which again goes back into Nvidia because in OpenAI has to buy a lot of chips from Nvidia. Amazon, on the other hand, uh, has funded this company called Anthropic, and Anthropic again uses AWS for running its data center, compute, processing, all of that, right? So there's again a looping of money there. Microsoft, for example, invests in OpenAI. OpenAI pays for Azure, which is Microsoft Azure, right? And so on. So a few handful companies are doing business between each other. So somebody raises funds, gives it to the other guy. So he's raised money here. That becomes revenue for some other company. That revenue for that company is again transferred to the one who is funding in the form of, so the revenue there goes to revenue of, for example, Microsoft or Azure or AWS, right? So in that sense, the earnings growth that you're seeing is basically someone's funding being raised somewhere else, right? And if there is now this party is good as long as the valuations keep going up, there is incremental capex happening, there is incremental revenue that these guys are chasing, all of that, and that party will continue as long as more and more money is being put into this. But whenever this capital flow stops, then you will see that this entire stack of cards will fall down like anything. And just these 7, 8 companies, which again contributed to S&P reaching all-time highs in the last 2, 3 years, you might see a situation where all of these companies will again come down like a pack of cards, right? So their valuations, their earnings, their revenues will come down significantly whenever we see a slowdown. And in my view, the previous slide and this are linked together, because think of a situation where, let's say, the the 3 year, the 2 year, or the 3 year, basically the cost of capital goes up. Once the cost of capital goes up, then the free availability of money is not there, and in which case, funding or the capex, for example, these companies put together over the last 2, 3 years have put $800 billion in data center investments. If those investments were to slow down, then the chip buying will slow down, the use of AWS, the use of Azure, all of that will slow down, and that will lead to significant re-rating of these stocks, right? So do see a huge risk here, and most likely all of these things will come together. We don't know what can be the trigger for this correction, but whatever be the trigger, there is a significant downside that one can see in the US markets. And that, I believe, will be the reason for the next crisis. Uh, Now, this is a known fact, and a lot of people know this. It's widely discussed on YouTube and social media and internet. But I still do believe that whenever these corrections happen, there will be a significant selling across the emerging markets, and Indian markets will see additional selling on top of what we've already seen over the last 1.5 years, right? I think we'll continue to see more selling in India whenever this happens. Now, I will talk about the Indian markets also, but again, so now let's move to, so this was all about US and what's happening on the AI side and the yield curve inversion that we talked about. But what's happening really with China? So China, as you know, that over the last 1.5, I think ever since Trump started the tariff war with China in April, we've seen China handle that very well, right? On the back of their supply chain dominance, especially in the rare earth metal side. Right now, what we are also seeing that as gold inches up, as we are seeing gold becoming expensive and expensive, we we are not seeing any slowdown in the buying of gold by central banks, especially Chinese central bank. China has been regularly, buying more and more gold, and I think there's a very strategic intent to why China is buying more and gold. Uh, so as you know that China is trying to reduce dollar dependency, which means it doesn't want to hold dollar reserves on its books, right? That could be because of this whole tariff war. They don't want to basically take any more exposure to dollar treasuries than what is essentially is required. And over a period of time, what they're doing is they're basically selling their dollar reserves and buying more and more gold. And what we understand from all the articles that are going on the internet is that China eventually wants to back the yuan with gold, right? So they want to create a system where yuan will be backed by gold. And we could then, in the next couple of years, see a situation where trade can be settled in yuan because it's backed by gold, right? So till date, yuan has been a very flexible currency. China has been using yuan, to basically increase exports. They devalue it whenever they want to, right? So, but I think what they're now trying to do is basically use gold and the massive gold reserves that they have, and they are essentially building right now to back the yuan currency, and that currency will then sort of become, at least that's what they are wanting to do, will become like a currency, especially within the BRICS zone, as a settlement currency because it is transparently backed by gold, right? So that's the strategic intent of buying so much gold, and because of these reasons, we believe that the gold rally will continue, right? I think uh, if you look at the stark difference between gold between US and China right now, what you will see is that a lot of investors in US are basically very bullish on Bitcoin, right? They believe that Bitcoin will be the next whatever. Bitcoin will basically protect them against and a possible inflation. Whereas the Asian countries and the Asian economies, China, India, a lot of us, we believe that gold is the true, currency, and we've been buying a lot of gold, right? Uh, so the U.S. investors are very bullish on Bitcoin, whereas most of the Asian investors are very bullish on gold. And you know, it's a matter of time whether Bitcoin is more stable or gold is more stable whenever the crisis arises. But in my opinion, again, gold is the real true currency. There is no sort of doubts about that, right? So eventually, whenever I don't know if the Bitcoin will crash or not crash, but one thing is for certain that gold prices will keep going up because a lot of central banks are continuing to add more and more gold. The other reason why gold will keep going up is because there is this general de-dollarization trend where none of these, central banks want to hold a lot of dollar. US by its own plan, the Mar-a-Lago, treaty that was supposed to be one of the biggest elements of that treaty was how do we devalue the dollar while maintaining the reserve currency status, right? So I think there is a long-term trend of de-dollarization. There is this other, uh, you know, thesis that US wants to use de-dollarization to basically pay off its $38 trillion loan, right? So they'll basically print more money and reduce the value of the dollar itself so that they can easily pay off the 37, $38 trillion of debt that they need to pay, right? Again, that will lead to huge inflation, which will again push the gold prices up, right? So de-dollarization and whatever US is wanting to do in terms of paying off its debt, all of that will basically lead to gold and silver prices going up. Also because the central banks are buying because they want to create their own separate currency. Plus also inflation is going up in US significantly, and that will again lead to more and more buying of gold and silver. Silver also because it's an industrial metal. Now between the two, gold and silver, and I've talked about this before, gold is a more stable rally, whereas silver is a more volatile rally, and silver tends to move fast, and silver also tends to fall fast. Now, as we stand today, I am of the opinion, again, not a buy recommendation, but the opinion is that gold and silver rally will continue to go up because we've not even started to see any correction, any significant correction in the S&P 500. Now, if you look at the last peaks that have happened in gold and silver, they have happened post the crisis, right? So post the 2000 dot com bubble, gold and silver peaked. It took about 6 months to 1 year for the peak formation, which means the crisis happened, and then 6 months, 12 months after the crisis, we saw gold and silver get to the all-time high. Again, that happened in 2008 also. 2008 dot com, sorry, 2008 financial crisis happened. And then in 2011, we saw silver and gold peak. Almost after 2, 3 years, the peak had formed. Up, of course, after that, gold saw a 20-30% correction, whereas silver came down significantly by more than 50-60%. Right? So that's the risk with silver as against gold. Whenever the correction happens, gold will see correction, but not so much as silver. Silver, you will see very sharp rally also, and very sharp corrections also. So be very careful when you sort of take any trade in silver. This is not a buy sell recommendation. We do certainly believe there is much more upside here. And what I also want to do is basically, um, I will post a chart basically on silver basically has given a new all-time high breakout, right? So from that sense, silver will there's a lot more potential. Silver has broken the 2000 and the 2008 level. So we believe from a dollar pricing point of view, the $50 per ounce is the breakout level, and we believe that silver can get to anywhere between 85 to $90 per ounce. So we almost see a doubling of silver from the current levels. Gold, however, may not double, but gold will be much more resilient, much more stable, and will keep going up, right? Because of the reasons that we discussed. Uh, any peaking out in gold and silver will only happen after the S&P crash. That is something which I believe will happen. We are not seeing any crash right now, but whenever that crash happens, post that, at least 3 to 6 months post that, that's when the gold and silver and these precious metals will basically peak out, in my opinion, in our opinion. Now, let's talk about the Indian markets. Sorry. Yeah. So now let's talk about what's happening in India. Uh, you know, so we've been through a down cycle. We've been through a cyclical down cycle. We've seen a lot of FII selling. From a fundamentals point of view, our credit growth has bottomed out somewhere in September, October, August, September. That's in that time frame. We starting to see credit growth go up, right? So credit growth inches up to 11.4% in October, uh, three fortnight, right? So credit growth has started going up. Uh, we are also starting to see some sort of earnings upgrade, right? After Q1, after the slowdown in Q4 FY25 and then Q1 FY26, we currently going through a Q2 FY26. But now we're starting to see some of the earnings upgrade starting to come, right? Um, because of the steps that RBI has taken, that the monetary and the fiscal policies that both RBI and the Indian government have taken over the last 6, 7 months. Because of those reasons, we're starting to see some sort of recovery. And if you look at the Nifty 50 right now, we are very close to the previous all-time high. So the question that we are asking ourselves is, are we expected to reach to another all-time high? Now, some people are saying that the new all-time high will be somewhere around the 27,000 mark. We don't know for sure. I think what we definitely know for sure that is that we will definitely touch the 26,000. Uh, as we see more and more recovery, more and more earnings growth, more and more credit growth, a lot of banks are starting to look up, especially mid cap, small cap banks are really looking good right now. Plus, if there is this additional, news that some sort of trade agreement can be reached between US and America, that itself will take it to the previous all-time high, right? I'm not sure if we will cross the all-time high, very conclusively, or it will be a short-term, surpassing of the 26,000 level post, which again will correct. But even if we go beyond the 26,000 mark, like I said, there is this looming crisis. There is this potential recession in US, which just about around the corner, can happen anytime. This valuation bubble that is there, uh, coupled with the inversion that we've seen in the yield curve, that can quickly materialize over the next 3 to 6 months. We don't know about the timing aspect. So when we think about the next 6 months, we have this risk in mind. where we believe something bad is about to happen, uh, and not for 5 months or 6 months, but a good, about 7 8 months. So accordingly, we are trying to position ourselves for such a scenario. Now, again, like I said, we are bullish on gold, silver, so we'll continue to hold all the gold, silver positions that we happen to hold, and we might add more because we want to increase the allocation of gold and silver in the overall portfolio, right? From that sense, we might continue to in short tranches might want to increase the allocation of gold, silver uh, as a percentage of the overall portfolio. Strategy number two is that we want to move some of our capital, and not immediately, but over the next few months, we would want to move some of that capital to NCDs and bonds, right? Now, ever since we started this business, we've not evaluated bonds, we've not invested in bonds. Last year, we did shift some capital to liquid bees, right, LT Guild bees, and that did well for us. But we are now evaluating high sort of return assets in the bonds and the NCD side, right? So we are in touch with a couple of fixed income providers where you will see, our clients will basically see some of that capital move to fixed income instruments where we believe that we will make a significantly higher returns than what is provided by liquid bees and all. And from a 1 year time frame, we would want to hold these investments, right? So, like I said, slightly higher allocation to gold, silver, some allocation to about a 15 to 20% allocation to debt instruments, which includes liquid bees, but which also includes bonds and NCDs. Uh, and we will also continue to hold some stocks, but the proportion of the stocks that we hold will come down over the next 3 to 6 months, right? By So in 3 to 6 months, we are basically looking to again get into a capital protection mode like we did last time, uh, right? Uh, so that's basically the intent. Between the stocks that we hold, like I said, we are very bullish on the EMS sector. It's been doing well. Discretionary consumer stocks because of the GST spending, that GST cut that we saw. I think the March Feb quarter is where you will start to see some of these discretionary consumer stocks starting to do well. And banking sector again is doing well because of the credit growth that has starting to come, right? And some of these mid cap, small cap banks are really, uh, undervalued. They have a lot more potential in terms of the upside. So those are looking really good. But yeah, I think that's the overall view. We are again, like I said, overall conclusion of this presentation is again trying to get back into a capital protection mode, uh, uh, because we do foresee certain risks, not from India but outside India. Uh, we in some sense we've already hedged our portfolio as we stand today, but I think we need to do more hedging because we do not want to participate in the next crash, right? And that crash is going to be significant, and might be also very sharp. Like, the one that we saw, the correction that we saw starting September, October last year up until March was a 6 7 month long correction, right, which happened over a period of time. What we might see uh, with the AI bubble bursting and all of that could be a crash which will be much more short term, which will be much more steep, and a lot will happen in a very short period of time. So it's important that we let go of the last leg of the rally. Uh, so we might be wrong for the next 2 3 months. Let's say if we start protecting our portfolio today, we might just be wrong for the next 3 to 6 months, but from a 1 year point of view, I think we'll still do really, really well, right? So I think from our point of view, from Wealth Culture's point of view, the way we are looking at it, it's important to now diversify your portfolio, have additional exposure to fixed income instruments, And fixed income instruments can give you anywhere between 13-14%, right? If you take exposure in the right companies, so you could be looking at a 13-14% return, even in the very worst of times, right? So that is what we are planning to achieve. My team will reach out to all our clients, existing clients, to get that done, and these will be traded listed bonds that we will be getting into as part of the plan. So whatever setting up that needs to be done to be able to take exposure to that sector, we will do that over the next 3 to 6 months. But this is just sort of a early, announcement as to what our plan is over the next 3 months, right? I think by December or before Christmas, we should have positioned our portfolio to basically address this huge risk that we are seeing in the US markets right now, right? So with that, I will end this monologue, and happy to answer any questions. If you have any questions, please put it in the comment section, and I can take those questions up. So, maybe because I keep getting questions from our clients. So, they keep asking this view on gold, silver, and whether it can keep going up. Uh, and meanwhile, if there is any additional questions that you have, you can, uh, put it in the chat section. But I'll just try and answer what we generally receive from all clients. So one question that we receive is, can gold, silver go up? Yes. So like I said, we definitely believe that gold and silver rally will continue to happen. And in my opinion, one should not be selling. One should only be selling gold and silver or rationalize your position in gold and silver only after some sort of significant correction has happened in the S&P for whatever reason, right? Whether it be AI bubble or, you know, price to earnings reaching all-time high, whatever be the trigger. But gold and silver basically will peak out after the crash has happened. So, Saurabh, okay, first question is from here. Should we continue investing in Nasdaq index in a staggered way? No, so we are very bearish on Nasdaq or any US index for that matter. Like I've been telling you that uh, we believe there is a major risk to Indian markets, especially coming from US markets. So obviously very bearish on US markets. That goes without saying. We do not, in fact, we have not taken exposure to Mafang for the last 1 year, ever since I've told that, US markets are looking expensive right now. It's almost 1 year since we've been saying that, but I believe that now the time is sort of there roundabout corner where you will see a correction in US. So obviously we are very bearish on US, not advising any of our clients to take any exposure to US. In fact, if you do have exposure to US, please rationalize because markets have really run up a lot. Valuations are very high, and in some sense there is a bubble. It's not, and this is not a broad bubble. This is a bubble just between the 7-8 companies that have driven the index significantly. So bearish on Nasdaq, bearish on S&P, not advising any of our clients to take exposure to any of these sectors. With the US going into recession, will rupee appreciate? Definitely not. What will happen is that dollar is still the reserve currency. So if there is any crash in US, there will be selling across the emerging markets, and dollar will get bought into, which means dollar will go up and rupee might see even more correction, or it might continue to be at the 88, 89, 90 level. Now, we've already seen a lot of correction, a lot of selling in the rupee, because almost $21 billion of selling has happened in Indian markets, and that all of that capital went back into US and then went to other economies. But as a result of that, Indian rupee has bottomed out. We believe that will continue to be the case at least till this whole collapse happens. Till that point of time, because what will happen is that emerging markets में selling आएगा, selling होने के बाद people will buy the dollar. Dollar still continues to be the reserve currency. They will move to bonds. So they will sell the emerging markets. That money will get deployed in bonds at 5%, 6% interest rate, whatever be the interest rate, whatever is the yield in US. So that money will get into long-term bonds there. Uh, what are fixed income instruments that you're looking at? So we are looking at a couple of NCDs. These are bonds. I can't reveal the name here right now. So we have quite a few fixed income bonds, corporate bonds, you can say so, right? Because government securities don't give you a lot of interest. So 6-7% is the max that you make on G-Secs. So we are looking at some corporate bonds that we can take exposure to that give us returns somewhere in the range of let's say 12 to 13, 14% also. Of course, these are risky bonds, slightly risky. The credit rating is somewhat lower, but the what we very strategically we will select bonds that have zero exposure to US markets and are very stable, and these companies will do good business in India. So right, so completely domestically linked business, and zero connection to US markets whatsoever. And in which case, even though these bonds may not be AAA rated, but they will still have zero exposure to US markets. And from that point of view, I think even if we go through a crash, there is very little scope for some of these companies going into NCLT or basically declaring bankruptcy. And that is how we will go about selecting these bonds. What is the credit? Yeah, so like I said, these will not be AAA rated. But again, when we do that selection, we will not, for example, take bonds of companies that do business in US, right? We will not do that. We will invest in corporate bonds where the entire business comes from India and locally domestic driven companies, uh, so that if there is crash in US, that doesn't affect these Indian companies in any way, at least not the tier one impact. So level two, level three impacts can be there because overall economy will get affected. So definitely there will be some level two, level three impact, but not direct impact. And these companies, will have some sort of cushion in terms of managing that level two, level three impact, so to say, right? Very solid promoters, solid businesses, that kind of company, but not AAA rated because if you become AAA rated, again, the interest rate comes down to 7-8%. The idea is to make slightly higher it. How to how to spread investments in the next 3 months in terms of percentage. So, uh, look, I will say that any incremental equity exposure that you take, I mean, any incremental deployment that you do in the markets right now should not be in equities, right? So first point is that don't incrementally deploy in equities. Start deploying in fixed income right now, incremental investment, and don't look out for there are good opportunities. Look out for opportunities that give you slightly higher interest rate. Point number one. Point number two, whatever you are holding, especially in terms of small and mid caps, try to see how you can time the exit, right? So, for example, we made some good investments where we are in significantly profitable position right now. So over the next 2-3 months, we will see how we can reduce those positions, because the fact is whenever these crashes happen, the small and mid caps go through the maximum amount of correction. So that is something which is priority number one. So you want to get that out and again move that to either large cap stocks or fixed income. Again, large cap will also correct, right? So it's not like large caps are safe haven, nothing like that. They will also correct. So, but of course, it's better to have it in large cap than small and mid cap. Uh, so I think what should happen over the next 3 months is that a good 60%, 70% of your portfolio should be between gold, silver, fixed income instruments, uh, and you know, let's say liquid instruments, right? I say liquid because whenever that correction happens, we should be able to sell that money and start buying the bottom, right? Because unless you sell the peak, you can't buy the bottom, right? So which is why you need to do that all of that activity over the next 2 3 months, so that you are in liquid, you are in safe places, and whenever the timing is right, post the correction, you should be able to basically sell off your liquid investments and start again deploying it in equities. And that really is, the most powerful thing to do, right? If you are able to sell at the right time, you are able to buy at the right time. Otherwise, just participating in the correction means that at least 1 to 2 years of time is lost, especially to recover your losses. Because of course the markets will recover, but it will take 1.5 2 years to for the market to recover post that. Right. So I hope my answer was helpful. And of course, for our clients, we will help them do it, right? So we will, me and my team, we will reach out to you. We'll make sure that over the next 3 months, we are gradually moving the portfolio to safe zones. And we are making sure that about 60 70% of the portfolio is invested in very capital protected assets. And when the timing is right, the last 30 40% will also be done. Do you recommend physical gold or ETF? Of course, ETF. I mean, um, physical gold you should buy only when you intend to convert that into jewelry. So we had a question from one of our clients. They wanted to buy, for the festive season, they wanted to buy some jewelry. So I advised that why don't you buy physical gold and keep it, right? And whenever you need to convert that into jewelry, you can just pay the making charge and convert into jewelry, right? But buy physical gold only if you want to convert it into jewelry at some point of time. At least you can freeze the buying price right now. If you buy physical gold, at least you will freeze the buy price right now. Uh, right? And whenever you need to convert it to jewelry, you can always pay the making charges and get it done into jewelry. Or if you don't want to get into jewelry and whenever you want to sell, you can sell. But ETFs are just easier to buy, liquidate, very easy to handle ETFs. And ultimately, when we are buying ETFs, the fund house essentially is holding gold reserves to that extent, right? So we did see some supply demand mismatch in silver very recently, because of which there was a sharp up move and then again a sharp correction also. Silver has been falling for the last week, and a very sharp correction because ETF prices had gone up due to unavailability of silver in the physical market. Right now that availability has again come back, so we did see a sharp correction in the ETFs also. But so don't buy into those. I mean, don't buy because of the artificial rise in ETF. But now those prices have corrected; they are again at good levels. So I think these levels are good. You can buy ETFs. Uh, much more easier to handle and make money out of ETFs than PCP. Any other questions? Otherwise, we can end this. Okay. Thanks a lot for your time. I hope this session was useful to you. Again, no buy sell recommendations, because we're doing this on YouTube, and people who are not. I mean, we have our investors also, but a lot of people who are not our investors. So again, none of this is buy sell recommendation. Please check with your advisor before you take exposure to any of these instruments. This is just for Gyan, and hope this Gyan helped you and will help you in taking your investment decisions. So that's it from our end. Thank you, and you know, do well. I mean, Hope you do well with your investments and you protect your capital and keep growing it. Uh, just concluding statements I would like to make that even if you are able to make double digit returns over the next 1.5 years, that will be very, very good. That will be excellent, just excellent, in my opinion. Right? So do not chase returns right now. Start focusing on capital protection. This is the need of the hour. Okay. Thank you.